Get a job at a Domino's. Domino's has minted so many millionaires because they only recruit from within the United States. So you have to already be working at a Domino's, and the average Domino's franchisee owns like 5 franchises. So they're making $1 million in profit. And the guy started as a assistant manager, or delivery boy in a Domino's.
Welcome to the third episode of the Great Enough podcast. In this episode, I talked to Patrick Findaro, the co-founder of VetaBiz. This episode is all about franchises. So if you've ever been curious about how to invest in a franchise, how much money you need to invest, could you get financing, or do you need to put up all the money yourself, how to choose which franchise to invest in, and a bunch more. This episode is packed with a bunch of useful information, a lot of things I had never known before actually reading his book that just came out and talking to him in this episode. I really think you're going to enjoy what you're going to learn in today's episode. Well, Patrick, welcome to the program. First of all, we're going to talk about something today I know very little about in terms of an investor or type of business. Obviously, I know a little bit more in terms of visiting franchises as a consumer, but why don't we just kick it off and start talking about why to invest or start a franchise business?
Yeah, definitely. I think the biggest pro of the franchising model is that it's been proven. And if it's done right, someone selling a franchise license on a concept that is easily replicable and that makes financial sense.
Okay, so you don't have the test something out like the I'm drawing a blank on the name right now, like the rapid
Product
testing
market
for startups.
fit,
So like, exactly.
You know the consumer wants it. You don't have to spend a year, 2 years, 3 years trying to get that product market fit. The consumers already want it, whether that's B2C, B2B. There's all different types of franchises in many different industries, and that's the idea with franchising, is that you can hit break even a lot faster, or at least much more predictable than if you're going to do a startup.
Yeah, no, that makes sense. So I have right here something that I think just came out recently. So how to buy a franchise employee to entrepreneur in 12 weeks. Why don't you just walk me through a 12-week process from somebody who is maybe unhappy in their current job to being an entrepreneur running a franchise? What would that process look like?
Yeah, definitely, Jeff. And just as a background, we released the book November 23rd, 2022. But I've been in the investing in franchising space for over 10 years now. And it's taken place over thousands of interviews with franchisees. So people that are running the day-to-day operations of, say, a McDonald's, as well as with franchisors. So say the guys from the corporate office of McDonald's in Illinois. So myself and our team has interviewed thousands of franchisors, franchisees, different professionals in the franchising space. So the book was basically the result of all this work and just making it in a condensed form. But week one is like, what do you want out of life? What are you looking for? Without clear goals and objectives, whether it's a franchise, buying a business, startup, it's going to be hard to determine what the ideal option is if you haven't defined what you want. And ideally, you're combining passion, purpose, and pay. Maybe you're not getting the passion side, and you can get that through volunteering or other activities. But you at least want to have 2 of the 3 in your franchise business endeavor. And then week 2 is the financing side. So we're happy to dive more into that, but are you going to just do all equity, friends and family, retirement rollover, SBA loan on the debt? So there's all different mechanisms to finance your franchise that you should consider. Week 3 is deciding your team of trusted advisors. And really the number one advisor you need to have is a franchise attorney. All the other advisors after that are optional, we say. But no, you need to have a franchise attorney. If anyone leaves anything today, it's a 200+ page document that you're going to be signing. You need an attorney to review it. Week 4 is that initial franchise search. So getting your feet wet and looking at different franchise concepts that are currently seeking franchisees. Week 5 is that initial reach out, seeing which franchise brands are available in your territory, maybe seeing if there's any resale opportunities, and having that initial call, that initial discovery conversation. Week 6 is research week. So you're going to receive the franchise disclosure document, also called the FDD. again, over 200 pages, lots of financial information. You start setting up your pro forma, and you start diving into the information that you've received and you found on the public domain on that franchise. Week 7. So remember, the first call was keeping things light. And now week 7, it's deeper dive with the franchisor, where you can ask more pointed questions that you wouldn't maybe ask on the first date. So that's week 7, going on deep dive calls with franchisors, and we arm you with all the questions to ask. Week 8, you got to validate that information. So you've collected a lot of information from the franchisors you've spoken with. You're going to validate that with actual franchisees, people that are operating those businesses, and to see if the financials and what the franchisor is telling you matches up with people that are actually running the business. Super important. Number 9, market research for your area. In the zip code city that you want to open up, or even the city block, does it make sense to have that type of business concept? Week 10, securing the financing. So remember, back in week 2, you looked at different financing options. You might have engaged the services of a financing consultant, and now you're tying up loose ends, and you might be applying for the SBA loan and having it contingent on the franchise, securing a location for the franchise site. And then week 11, that franchise attorney, again, the one trusted advisor you need to have is negotiating the contract, the franchise agreement on your behalf. And then week 12, you're signing the franchise agreement and you're then commencing the operations. If it's an acquisition, you're starting probably that same week. And the old owner is going to be training you. If it's a new build out, a franchise that you're starting from zero, you're going to do the training program within a month with the franchisor and open a month to 12 months after. 12 months would be like a very big build out for a restaurant, especially in an area like I live in Miami Beach, where permitting takes a long time, construction takes a long time. So there you have it, 12-week course that we've really condensed, where if you did it yourself, it could take 6 months, 12 months, where we've dumbed it down and given you the information you need to make a franchise investment within a 12-week time frame.
Yeah, no, I think that's really interesting. And we'll talk about this more later on, in terms of that. To me, sounds like a whole lot to jam into 3 months, to 3 months. But I think, if you have the right trusted advisors in place and things like that, it seems like something that, if someone is guiding you through the whole process, would be doable. But tons of questions and things to get into that I think will give people more of a feeling of how a business like this could potentially work. And so, how would you think about deciding? You mentioned the passion, profit, you can say that again, but like, how would you decide which franchise to invest in? So I think that there's probably a ton of factors to think about. What are the things that are most important when deciding, Domino's or Chick-fil-A or Starbucks, or, and we'll talk about more later. I think of restaurants. When I think of franchises, there's clearly plenty of other options as well.
40-50% of franchises are restaurants. So you are right to think about restaurants.
But how would I go and make this decision if I was sold I want to start a franchise? So how to choose which one?
Depending on your earnings that you're making now and you foresee in the next 3 years. Say you're making 70K, 80K. There's going to be a lot of opportunities that are going to clear that 80K, 100K mark, where you as the owner working day to day can expect to make that. Say you're later in your career though, and you're making 200K or 300K. There are opportunities for you. It's just going to make it a lot tighter, where it's going to be harder to find ones that make sense on the pay side compared to what you're currently doing in your job and in your career. Passion.
Okay, so you think about this just really quick to follow up on that. Sure. So you think about it kind of as what you're saying in the book, from entrepreneur to or from day job to entrepreneur, of like thinking about, hey, what am I making now? What's the investment needed, and what type of franchise could essentially give me some replace security that in a certain amount of runaway I could replace my income.
Replace the income and create an asset. So like Subway, for example, you're gonna invest $350K to open a new Subway. Running it day to day, you might just make $60K, and when you come time to sell, the resale value for a single Subway is like $200K. So you're making $60K in earnings. Probably we're making more in your last job, and you're gonna have a capital loss when it comes time to sell. So sadly, there are quite a few franchises where the resale value is less than the startup costs, which is a huge red flag. And then there's other franchises like a home care franchise. You start for 150K, 3-4 years down the line, you're making 1.5 million in top line revenue. You're doing a 18% profit margin. You're doing pretty well, $150,000, $200,000 plus as the owner operator, and you've created an asset now. So you invested 150K. You could sell that business, depending on how it's operating, 600K, 800K, $1 million. So it's income replacement, but also what business has the potential to really create an asset.
Okay. All right. And so what are the other factors in terms of deciding which is the right franchise?
Purpose. What gets you high in terms of like from a work perspective that you really enjoy? Is it mentoring people? Do you really like sales? Do you really like marketing? What attributes that you're uniquely good at and that you're going to drive success with your employees, with the vendors, with the customers, and that you're going to get really excited with, and you're going to be fulfilled in. So if you're really good at sales, there are opportunities where you really can leverage that, and you can rely on the franchisor to provide the product, or you might want to hire a key manager to help with like the operations side. So that's the purpose side, and then the passion. I would personally invest in something that was healthcare related because I'm passionate about that industry. I see also the purpose in it, and I would like to see that impact and that you have a lot of jobs. But I do like mentoring people across our company. We have 40 plus employees now. So that's just me. So everyone's different, but deciding what gives you purpose and what you can get behind and be fulfilled in, what makes you money, and then ideally you're also passionate about that.
Okay. So if I identified an industry, something I'm passionate about, maybe the income numbers are right, how would I actually go about verifying that? Or what are red flags to look for of like, hey, the documents I got say that this is the case, but what are some of the things to kind of look out for where, the chance of that actually coming to fruition maybe, isn't really in the realm of reality. So how would you go about kind of that process of investigation and know that, hey, I'm interested in healthcare. All this stuff seems to make sense with, if everything is true, then cool, this would be great for me. But, I imagine there is some failure with investing in franchises or building a franchise business. So like, what are the things to kind of look out for to lower that risk?
Definitely. Well, as you saw in week 6 of the research week in the book, businesses that advertise a average sales or average profit, but then you see in an asterisk that it's like only 5%, 20%, or 25% of the locations that do that. If someone's starting a relationship with you and from the get-go they're overstating their financials, and you have to look at like a very small print to see that it isn't truly the average, I would say that's a huge red flag. Also, 59% of franchisors do disclose their financial information on the franchisees, or at least some select franchisees, but the other 41% don't disclose any earnings, any unit level earnings. So that's a red flag. And you'll see big name franchises like Subway, where they used to disclose financials, but then the sales took a dip for a year or two, and they just pull their item 19. Item 19 is the item in the franchise disclosure document that's disclosing the financial performance of their franchisees. So that's a big red flag. If they're not sharing with you the financials in the franchise disclosure document, or they're overstating it with advertisements, and that's how you got in contact with them. And then another one that is, unless you're in the industry, you want to really understand is a lot of times they show you what the corporate locations do or the affiliates do. But that's someone that has maybe 20, 30 years of experience selling ice cream, and they're showing you the corporate financials for their 5 ice cream stores. You coming in as a franchisee, what could you expect to make? Generally, it's going to be less than what the corporate stores are doing.
Yeah, so I think, and you were recommending in your book too, the importance of speaking with multiple potential businesses within a particular industry and potentially more beyond that. And I think for someone watching this or listening to this isn't the same as wanting to invest in Tesla, and all public companies like Tesla, let's say, have a 10K and they have certain documents, and it's kind of presented in the same way. I imagine with looking at the documents you get when you're thinking about a franchise, there's a lot more variability in terms of the information that you're potentially given. And yeah, clearly maybe it's a really interesting business, but if they're only showing a subsection of it or not really as forthright in terms of giving information, that if things aren't going well, that's not a potential great sign for how things could go going, how they might go going forward in terms of a long-term relationship you're building with this type of business.
And we make it easy. So we put the data from the FDDs on our website, vettedbiz.com, for over 1,000 franchises, as well as if they don't disclose financials, but we have enough information and we vetted that with franchisees, or we've purchased it from third-party data providers, we'll include that information. But it's on you as the prospective franchisee to verify that with existing franchisees. And we recommend talking to 5 franchisees, and also talking to some former franchisees, those that closed down, maybe sold the business, and ask about their experience, how much they were making. And the pro forma is really key. So working, whether it's with a financing specialist or with your accountant or an accountant that specializes in small businesses and can help you formulate a pro forma, sharing it as a Google Doc with prospective franchisees on that call to verify the information and just say, hey, we've built this pro forma. Does it make sense? Is there anything that you would adjust?
Yeah, so the pro forma is essentially your projection for financials of what the business is going to look like going forward.
Exactly. The next 3 to 5 years. When are you going to open up? When are you going to break even? And when are you going to start making 5K? Those are three key things.
And then how do you go about finding other franchisees? Are they very clear of like, here's a list of all of them, contact who you want? And then I think probably the tougher one is someone who left the business. Like, where do you go about finding those contacts?
Great question. So in the franchise disclosure document, it's all disclosed. So current franchisees will give email address, phone number. It will give you some contact information to reach out to all the existing franchisees, as well as any franchisees that left the system in the last year. So you can dig back. There's state databases where you can get the FDDs from thousands of franchises for free. We make it easy on vettedbiz.com, where you can go back the last 4 or 5 years for Subway and then contact those franchisees, or even just go on our site and make it easy and just scroll through and start calling the franchisees. The franchise development person, the franchise salesperson representing the brand will also give you some ones that are open to talking to franchisees and maybe give you some warm intros. But I do recommend not just talking to them, talk to some ones that are not just being passed from the franchise development, where the franchise development person knows they're going to give a very positive review of their experience. If you've reached out 3-4 times, you're still having an issue, offer an Amazon gift card, $100, $200 to get on a phone call with them. It might seem like a lot of money to you now, but if you are able to identify a red flag and we're in the position to invest $100,000, $200,000, $300,000 more, that $100 is definitely going to
that's a good use of $100 for sure.
Yeah.
And I think that's a good transition to, and you just mentioned a few numbers, but how much does it cost to open a new franchise or acquire a franchise? I'm sure there's a huge range, but how much does this vary? Is it by industry?
It's going to vary a lot by industry. The median franchise fee is $35,000. So that's what you pay to the franchisor, and you have the license to operate that brand and all their training and support for a 5-year, 10-year, 20-year period. Most of the time it's a 10-year period. You're also going to pay a royalty that's going to range anywhere from 4 to 8%. But you have some franchises that are outliers, like Kumon, 20% plus royalty. We estimate it's generally 25, 30% royalty for Kumon. So you have some franchisors that charge an arm and a leg for ongoing costs. But in terms of the initial costs, that franchise fee is anywhere from $20,000 to $50,000. And then the startup costs, including working capital, securing the lease if you need to operate in a retail location, build out furnitures, fixtures, all that. For a restaurant concept, you're looking at least $300,000. And for a brand like McDonald's, it's going to be 2 million plus. And then for a service-based business, think real estate property management, home care, including working capital, is going to be closer to $100,000 all in.
Okay. Okay. So the Kumon example, they're obviously taking a lot of sales, but then you don't have all this crazy machinery and a drive-through to build out and all these other things. So I imagine something like that, that type of service business, you have, the physical location, but it's not on the specific corner and is with larger of investment.
The rent's going to be less, but Kumon's kind of a tough one because they were better in the past, but now, they're doing average sales at $250K. So if you're paying rent of $3,000, you're paying 30% of the sales to Kumon, the franchise brand. There's not much left for you as the owner. However, there are other retail type concepts or even education concepts where they're more doing, like preschools doing over $1 million in sales. So that's the key thing, understanding if you're going to sign a physical lease for a space and the average sales are less than $300,000, you got to kind of reconsider how important it is that you have customers come to you and then you're not going to the customer, because there's a lot of service brands like where you're doing kitchen and bath remodeling. One in particular that we were Dreammaker Kitchen and Bath, average sales 1.3 million. You might have a basic showroom, $300,000, $350,000, but you're doing numbers like that. Where also other ones where you don't have a showroom and you're able to make $300K, $400K, $500K. It's just basically you and
then you don't have the $3,000 a month lease with that.
Yeah, and it's like $80K, $100K startup, and you're making the same top line revenue as a lot of these retail type concepts.
Okay, yeah, no, that's really interesting to think about. So anywhere from what sounds like what you're saying, from $100,000 to several $1 million for kind of the big names that people think about, like a McDonald's or something like that.
Exactly. And I would say, if you have less than, say, $20,000 cash, I would recommend continue working, save up more. And because you can basically lever up with $20,000, you can get a loan, another $150,000, $200,000.
Okay, so that kind of follows up to one thing I was going to ask of what are the options for financing your investment in a franchise? Is it completely friends and family and money that you've built up? You've mentioned SBA loans. How does the normal person who invests in a franchise? Obviously, there's tons of variability, but what are the typical ways that someone comes up with that capital?
Yeah, definitely. So a U.S. citizen or green card holder investing in a franchise here in the U.S., it's generally going to be an SBA loan and or a 401k rollover. So imagine you had a retirement savings of $100,000. There are mechanisms that you can use those $100,000 to start your business. It's a bit of a complicated, convoluted process, but you can use those funds, and there are firms that specialize in rolling over your 401k for use in that business. And then the other one's the 7A loan, which if we were talking 24 months ago, the rates were like 5%, 6%. But right now with the prime rate higher, it's prime plus 2.75%. So it's more like 9, 10% to get an SBA loan. So that puts more pressure on the business model to really find a business that makes good financial sense. So your debt servicing doesn't eat away at the profits at what you take home. So some combination of 401k rollover, your just savings, friends and family, as well as taking on debt, principally through the SBA loan. And then there are creative solutions and programs like Chick-fil-A has an option where you just invest $10,000, and it's a very low chance of getting approved for the program, less than 0.5%. But you basically, with $10,000 investment, you can be an operator of a Chick-fil-A, a franchisee, and get 50% of the profits. Steak and Shake has a similar model. So there are some kind of pseudo partnership models With the Chick-fil-A option, you don't really get equity. You're more of like a super high paid manager with an initial $10,000 deposit. Because when you go
Okay.
to sell your shares, you're not going to make like 500K. It's basically, from what I understand, you get your $10,000 back.
Okay.
So there
So
are
just
some
one really
different
quick
models.
thing there. Yeah, one quick
Yeah,
thing on the financing part, and just to kind of mention to think about, obviously with, thinking about your retirement savings and 401k and the risk of doing a business like this, of obviously talking to a financial advisor, not taking 100% of what you have for your retirement and throwing that into a business, it could easily fail. And so it's obviously something that, there's, talk with your significant other and thinking through the risk and return of something like this to say,
it's
hey,
not my first
with
choice.
part,
Yeah, go to your
yeah,
friends and family first, and the savings that you have not within your 401k,
yeah,
because it could be a low chance of failure, but you're going all in on one asset. Where the 401k, you might be diversified across 500 stocks and bonds. So
yeah.
that's a
So it's
great
your
point.
it's the retire, your income that you're risking, because if it doesn't work out, you're not going to have the same income where you would normally put X% in your 401k every month or every paycheck, to taking money out of it to something that also. So I mean, I think there's kind of there's two potential risks there, where if it's a small percent of it, maybe, but clearly talk through with some financial advisor, important people in your life, or things like that.
And
Or
God forbid you default on the loan. In most states, they can't go after your retirement savings. So if you did the friends and family on the equity cash side and then lever it up with an SBA loan, your 401k should be shielded. God forbid the business goes under and you go bankrupt.
yeah. And so talk about the SBA loans. It's not something I'm familiar with. I'm sure there's tons of opportunities, and it sounds like a very common way for a franchise. What's the process for this? So I think you were saying someone may invest 10 or 20 or however many thousands of dollars and potentially get, 150 or $200,000 of an SBA loan. So
So round
walk me through that whole
example,
process.
say you're acquiring a business, a property management business, and you're going to buy it for $100,000. It's already up and operating. It's not doing incredibly well. The owner is making 40K, but he just started a year in, and there's definitely potential to grow the business. You acquire it 100K, you're going to have to put down at least $10,000, and then you can get a loan for the 90,000. And you can work directly with a commercial lender or a financing specialist that's going to shop your personal application together with the business around to a few banks to see which bank can get it approved fast and at the best rate and terms. So acquisition, generally 10% down, maybe 15% down. If it's a new build out, it might be closer to 30%, but we have heard of people getting finance with a new build out business as low as 10%. The whole process, budget in 2 months, could go up to 3 months, but we recommend you start that early in, week two, week three, and as you run your course, evaluating different business options, you're processing everything on the personal side, and you're starting to then present the business to the lender or the financial specialist to then get it funded, so you can start the business as soon as possible.
Yeah, in your book you went through this a little bit, but how often is somebody not able to repay their loan, or how often does this just whole starting a franchise thing fail? And then how can you kind of mitigate some of those risks?
Yeah, definitely. So, I mean, there's some brands like UPS Store, Orange Theory, where I don't think they even have a default on record. Now, that doesn't mean the fitness studio didn't fail or the UPS store didn't close down. They might have repaid their loan with savings they had or sold their house to repay the loan. But you do have some businesses, but saying that UPS store, you're not going to make a ton of money. It's going to be hard to become a millionaire owning a UPS store, but you're probably not going to close down. And you, depending on where you're living, you should have enough money to support your family based on one or two UPS stores. So the failure rate is low for those brands, and we have a list of the 20 franchises with the lowest SBA default rate. But then you have other businesses that have a super high SBA loan default rate. And during the pandemic, especially, a lot of the sandwich concepts had a high default rate, like Jimmy John's. as they were catering a lot to office workers. And those Jimmy John's franchisees just weren't able to survive. They ran out of cash, so they closed down. So the default rate, the SBA is reporting quarterly on the default rate. You have to kind of dig through a pretty lengthy Excel. We make it easy, publishing a lot of results on Vetted Biz, condensing that information for you, but we have it for brand by brand. There's some brands, sadly, for every loan that's paid back in full, one loan defaults. And then you have the other end of the spectrum.
So it's a coin flip, essentially.
Yeah, it's a joke. It's a coin flip. The government shouldn't be approving. You should get like an X if you're that franchise brand that just like keeps having franchisee defaults, because we're paying it as American taxpayers. So basically the bank is on the hook just for 15% of the loan amount. And then the government picks up the other 85% in most cases.
Okay, I get it. That makes sense. So does the bank get paid back first too? So it's like if it fails and they only get 20 cents on the dollar, then the bank ends up okay. And
they essentially liquidate all the assets. They'll try to go after your house, like depending on what you sign and personal guarantee. And then I don't know. Good question. I don't know the right of who has the top lien, if it's the bank first or the government.
Okay. All right. Let's talk about something a little bit more positive than stuff not working out. But moving on to
those can be good deals if you know what you're doing. Like I interviewed a franchisee. He bought a struggling home care business, was doing over $1 million in sales, but wasn't earning much, and like a lot of months was losing money. And he built that up to $8 million in sales, and should be at like $1 million EBITDA. So some people just go through different life changes or weren't good managers, and there are opportunities to potentially buy a struggling business or struggling franchise concept.
But if someone were to start a new franchise, so they found a location, opening it up, what's generally the timeline between, the 12 weeks, say, in your book and signing the contract to opening the door, making money, reaching profitability? And clearly with any of those, I'm sure there's a big range depending on the franchise, but just to have some type of an idea.
Great question. So it's going to depend a little bit state by state and what industry you're operating in. So if you're going to be operating an insurance business, for example, it might take longer. It might take 6 months to open because you have to get your license. You also have to secure the site. If you're opening up a restaurant, say in some cities in Texas, it might be more like 6 months or even less if it's a second generation restaurant. If it's here in Miami, I think it could be 9, 12 months plus to get the business open if it's a restaurant. So it's going to be a scale. A big fan of why I like the service-based concepts that you go to the customer. So imagine you're installing flooring, you're cleaning the exteriors of their house, CertaPro painting, you're just painting. You're painting commercial buildings, residential buildings. Those businesses get open fast and you break even generally much faster.
So let's talk more about those types of franchises, some of the ones that require less startup cost, less, build out, and something you could get started with much sooner. What are some of those businesses? I think you kind of named a couple, but if you could kind of elaborate a little bit more.
So, I'm a big fan of the businesses that are kind of complicated, like healthcare, or that people don't like to do, like junk removal. So you have a few junk removal businesses, 1-800-GOT-JUNK, College Hunks, where you're doing moving and junk removal. And all in investment, say $200K, $250K, including the truck and the working capital. And those businesses are regularly doing $1.5 million in top line revenue. And the franchisor in most cases is responsible for the marketing and sales. So they're booking the client for you, and your job is to manage the crew and manage the client. So you don't have to worry about sales, marketing. Generally, those franchise concepts are handling that part. Your job is to find, train, manage, retain, fire employees and contractors, as well as deal with the customer. And then the franchisor, in most cases,
find the customers.
is handling pretty much the rest.
Okay. No, that's interesting. That kind of goes against your bid on passion. I don't know how many people are like, I just want to pick up people's junk, but
There's
it's a
also like some
trade-off.
dog food franchises that make a ton of money.
Okay. Yeah, yeah.
So, that type of business, like pet waste removal, junk removal, you're not going to probably get the passion from those businesses. And so you're going to allocate more of your off hours to volunteering or sports that you love or something else. And,
Yeah,
and
so
you
that
have
that
you hit the pay hard and the purpose hard.
yeah. And then that kind of gets into my next question where how much am I going to be working if I start a franchise? Because I think that's a big thing. Like you were saying, I think with Chick-fil-A, it's like you're a really well-paid manager. And so you're
Yeah.
clearly at the restaurant probably most days and working pretty hard, where potentially with some other types of businesses, there's enough money to have a manager and at least maybe not in the first X amount of time, but afterwards to be like, I'm just kind of, making sure the team's doing what they're supposed to be doing. Maybe I do some of the interviewing. And so you have kind of certain roles that you're in charge of, but it's not a full-time job or more than a full-time job. It's turned into something part-time where you have some money coming in and you can spend more time volunteering, doing sports and doing other stuff and focusing on that passion, but know that your bills are paid for. So how does that vary depending on the type of franchise or people that have one franchise versus 10, or like how do you think about something like that?
I say for at least the first 24 months, you as the owner or minority partner is all in. Roll up the sleeves, working 40, 50, 60 hours a week. Again, you as the owner or someone is, or maybe you have a manager who's 25, 30, you give him a profit share or 10%, 20% equity interest in the business. But small businesses are fragile, whether it's a franchise or not. And I strongly recommend that you're all in yourself as the principal investor, or that day-to-day general manager that you're going to work out some profit sharing arrangement, or you're going to even give him a small minority stake in the business, and it could be over a set period of time. Now, there are franchise options that market themselves as passive business opportunities that are like vending machines, where you don't have to allocate a lot of time. But in general, I do advise franchisees roll up their sleeves, be willing to put in a ton of hours for the first 2 years to ensure the success of the business. And then from there, you can potentially hire a day-to-day manager and work 10 hours, 20 hours a week, maybe less, depending on that day-to-day manager that you hire. But I don't recommend people go about it the passive way. I don't currently own a franchise myself. I am open to investing in a franchise with a minority partner that's going to be running the day-to-day affairs. But right now I invest in franchise brands and just buy the stock at the brand level, like Wendy's, like Domino's. So that's how I'm invested with my personal finances in the franchising ecosystem, is just through public equities at the moment.
Yeah, no, no, I get that. And so for someone, obviously we've been talking about, hey, maybe not, it's probably not a good idea to invest your entire 401k, having some money saved up. It may take a year to get something off the ground. And so I guess two questions there of how soon, if it's going to be a year before we open the doors, am I going to be full time before the doors are open? Is it I can keep working and this is part time
Great
till that
question.
happens? Just to think
Yeah.
through of like, there's obviously what I need to pay to be able to get the doors open, but then like I need to live for X amount of time to get to the point of there's enough money coming in. And so how would someone think about too of, when can they plan on having their income replaced? Like how long does that take? And that kind of gets into, what somebody should probably have in their bank before moving forward on something like this.
Yeah, no, and you bring up some great points. I think every case is different. So someone's 27 years old, they have 30K in their retirement savings, they have no kids, not married, anything. Maybe their risk appetite's bigger, where they don't mind going all in and trying to hit a home run, but knowing that there's a 10%, 15% chance that it fails. However, you're married, two kids, your spouse isn't working, the stakes are higher. So you better be damn sure that you're going to have that income coming in. And ideally you keep that income for as long as possible until there's a switch and you can replace your income. I interviewed a mosquito, basically a pest control franchisee on our podcast channel, Franchise Findings, about 10 months ago. And he works full time at a large bank, and he works with the franchise 20, 30 hours a week. At this time, he does not want to go all in on the franchise. He's very happy with having that third income source, including the income that his wife makes. So it's going to be case by case. But if you have a sugar mama or sugar daddy, obviously that's going to help and take less pressure off you to potentially start the entrepreneurial journey a little earlier and be solely dedicated to the franchise business during the site selection process, during the build out, during all those initial phases until the business is open.
Yeah. So obviously what we talked about earlier related to the pro forma of how long do we think it's going to be till money comes in, and probably having a buffer. I've talked about in other videos in terms of emergency funds and things like that, but obviously having more than enough money where, you put together projections, it may come faster than you think, but probably chances are it takes a little bit longer. So having that well thought through ahead of time to make sure that, you're covered and not risking, paying for important things of your own, your families and things like that.
Credit facilities open up. So negotiate with your finance specialists and shop around at different banks, setting up lines of credit that you can draw down on just to have. But maybe, it might be a high rate, 8%, 9%, but you only start paying that if you draw down the line. Because say, Jeff, that you start the business and you thought it was going to break even in 4 months, and now you're at 8 months. And like last month it broke even, or it was like $2,000 above. Looks like this month's $1,000 below. It's gonna be tough to get financing from a bank at that point. But if you already have a line of credit approved, draw down on that. So get your financing in order before and overcapitalize the investment.
Yeah. I think on all aspects of your personal financial statements of what do you have in the bank, and then obviously, backup plans in terms of this may take a little bit longer. I don't want to take more money out of my savings to put into this, but there is a line of credit and yeah, so it's definitely something to for sure think about. So I think the next thing is there's clearly a ton that we talked about today, and there's information that you've built up over time. And so how do you recommend someone, what would be the process they want to go and do this on their own versus to hire someone like yourselves to look at a franchise? What are the pros and cons of those two options?
So with Vetted Biz, we have two companies. Between the two groups, we have 40 employees. We have Visa Franchise that acts as an advisor, acts as a consultant, but just for foreign nationals that are looking to move to the U.S. through investing in a franchise. If you're an American listening to this, we don't act as a franchise consultant. We don't act as a franchise broker for Americans, but we have a great relationship with Franchise Broker Association, and they have qualified brokers that can help you through every step of the process with identifying brands in your area and helping you throughout the entire discovery process. So we want to be your advisor. However, we have a lot of data on our website, vettedbiz.com. We have a quiz you can take that will then narrow down the options that best fit your needs. I would say Vetted Biz is kind of like a Zillow for buying a franchise or business. If you use a buyer agent to buy your home, you're probably well suited to use a franchise broker or franchise consultant that effectively is your buyer agent. They're going to split part of the franchise commission together with the franchise seller, that franchise development person. But if you like to do everything yourself, and especially if you come from within the franchising industry, definitely need a franchise attorney. But you might want to just go about it yourself and reach out directly to the different franchises. But I would say that's a good indicator is if you've used a buyer representative when you bought your home or bought multiple homes, probably should work with a franchise consultant throughout this process.
Okay. And so as you were saying earlier, at least from your current experience, are investing in some like public companies that are franchise businesses, and you have your own business. What do you see as the pros and cons to starting something from scratch that you see as an opportunity versus finding a franchise business to purchase or start?
Predictability. I've started a few businesses. One pretty much broke even in 2 months, other one over 2 years. And I thought the 2-year one would have taken less time, and I thought the 2-month time would have taken more time. With a franchise, the margin is going to be like a month or two either direction. It's not going to be years in either direction. With my personal experience starting multiple businesses, the time to break even and also hit that product market fit can take a while depending on what industry that you're in. And with franchising, you pretty much already have that. And there are some franchises that are not good businesses you should not invest in, but the franchises that have proven success and that you validated with franchisees, you should have a pretty good idea of the time to break even and the time to start replacing your current income.
Okay. No, that definitely makes sense. And so something that's really important for this channel is trying to help someone who is living paycheck to paycheck, maybe spending more than what they earn. There's just so many people right now that aren't in a great financial situation. What would you recommend for someone like that to go from where they are now to, as we were talking about before, potentially working on their business, as say a franchise or starting a business versus, working a full-time job plus and still not doing well financially? How could someone over time transition
using
from one
Domino's,
to,
for example, get a job at a Domino's. Domino's franchisees, Domino's has minted so many millionaires because they only recruit from within the United States. So you have to already be working at a Domino's, and the average Domino's franchisee owns like 5 franchises. So they're making $1 million in profit. And the guy started as a assistant manager, or delivery boy in a Domino's. So I would advocate, if you're living paycheck to paycheck and you have capacity to work even more, maybe get a part-time job at a franchise or at least the industry that you're maybe interested in. And then the financing aspect, if you're good and people like you and you're doing a great job, there are different ways that the franchisor can come up with the capital. The franchisee can come up with the capital. Maybe you give an interest in the business that you're currently working at. But let your objectives be known of what you want, because if you don't let people know what you're looking to do, they're not going to make an assumption that you want to be a business owner one day, and they're not going to they're not going to upskill you so you can potentially get to that level.
I really like that, thinking about it, because I think, a lot of people, you need to have X amount of money to make something happen. And that's obviously going to be really difficult for a lot of people, but kind of the strategies that you're talking about, which I think makes a ton of sense, where we were also talking about earlier, where, if I wanted to open a franchise and my goal is to be hands off and not essentially have to do any work on it, and I have someone like this that starts working on my franchise that just works their butt off and is a complete rock star, they're like, well, there's a lot less that I need to do. And then if the franchisor is giving me an opportunity to open new markets, it would be like, well, we're making some money from this. I have this manager that's amazing. Why don't I give them some equity, and why don't we go open a new one? And so the Domino's is a very kind of clear example of that. That's how the business is run. But I think if you become an expert in delivering pizza on time and people love you for that, and you can open 5 Domino's over a period of X amount of years and are doing really, really well, or if it's something healthcare related or anything like that, I think in that type of business, or as you were saying earlier, I like the idea of things that is not the sexiest business. And so if you're great at picking up people's junk or dog poop or whatever it happens to be, and you can hire people for that and manage them and get the job done, the doors will open, and you could find yourself with equity in a business, a management position, making some more money and getting paid versus the profits you're bringing in for something where, not too long before that, you were struggling financially. And so I think there's opportunities to kind of work your way up with exactly what you're talking about. So I think
you don't need a lot of
that makes a lot of sense.
But you want to have relationships with rich people. So whether those are friends, work colleagues, or manager, to the extent that you're able to do a good job, earn their trust, and then benefit financially, whether it is from an equity position or a profit sharing in the business, that's how a lot of people have made tons of money here in the United States.
Yeah. And one of the things that I'd always looked at in different jobs of what is my boss's job like? And so in that case of like, what is the owner of the franchise's job like? Is that something that I would like to do? And if I can make their job easier and eventually kind of work up into that position, or as what you said of just make it really clear, here are my intentions with this. I'm going to work, as much as I need to and push this forward and advance my career. And then opportunities can just appear from the hard work and effort, helping someone build wealth, build experience, and grow in their career.
Yeah, I think a lot of people rush into business ownership, and although we made a program to do it within 12 weeks, that doesn't mean you have to do it in 12 weeks, but we give you all the tools to make an educated decision in 12 weeks. But you might come to the end of the program and decide, you know what, I want more flexibility. I want to decide the product, strategy, and franchising is not a good fit for me. Or I want a business that already has cash flow. I'm going to just look at a franchise resale or existing businesses for sale. And then the startup process and then buying an existing business, that's generally not a 12-week process. And that's more like 12 months of planning, thought process, buying an existing business, lots of due diligence. So it's going to take a lot of time. We're going through our model, 12 weeks, you can decide if franchising is good for you or not, and then decide to keep your day job or pivot to startup or buying an existing business.
Yeah, no, that's amazing. I think that there's a ton of value for someone that has some capital to start a franchise or is looking to gain experience and build wealth. So I think this conversation was great. If someone wants to learn more about franchises, starting a business, and everything that you do, where do you recommend that they follow you, or where should they go?
Yeah, so we produce a lot of ways that you can consume our information. Our database of 7,000 plus franchise opportunities is available at vettedbiz.com. We also have a ton of franchise analysis on some of the largest brands as well as emerging concepts there. We have a podcast channel, Franchise Findings. Also, we're on YouTube. You just type in Vetted Biz. So whether it's video, audio, you want to dive into the numbers and just that, or you want a long form article,
the book too.
Yeah, exactly.
Yeah, I'll put links to all that down below. So in any way that you're looking to consume information about franchises, we'll make sure that they have access to that.
Yeah, basically, I mean, if you're serious about exploring a franchise, I would definitely recommend taking a look at the book. Jeff is going to include that in the show notes. And then listen to our podcast. Is every day I'm releasing an analysis on a franchise, and once a week I interview a franchisee or a founder of a franchise system.
Yeah, that's phenomenal. Well, Patrick, thank you so much, and hopefully have you on again to talk more about different opportunities like investing in franchises.
Thanks so much, Jeff. Really appreciate it.
Well, that's it for the third episode of the podcast. If you'd like to watch another one of our podcast episodes, I'll link to one up above right here. Also, if you want to check out Vetted Biz's YouTube channel, I'll link to that down below. I hope to see you in another video. Bye.